Have you ever tried to build a cash flow forecast or even a three-way financial statement in Excel, only to find there's a formula error and the whole thing falls apart? Hi, I'm Kate Clark, and in today's episode of Scale Up Smarter, I'm going to show you that there is another way to build a cash flow forecast and even a three-way financial model without using Excel. And it doesn't even involve AI. So let's jump straight in and I'll show you step by step how to build it. And if you stay with me till the end of the podcast, I'll even show you the platform that I use to create this model. And so here it is. Here is the three-way financial model, which is for a construction business for 3 years. So as you can see, things are looking pretty healthy. But what happens if we don't get some sales that we were planning? So let's switch off all of the commercial sales. As you can see, we start to lose. Well, this is our cash flow section here. We can also look at the profit and loss and the balance sheet. So it's a full three-way financial model. But actually, I really love looking at this report because you can see very graphically what happens with your cash. So just by turning that off, we can see the impact on our cash flow, and automatically we see the funding requirement that we will have as a result of that. So we can switch that back on. We can switch off any individual bits of this to see how they impact on our graph. And we could, for example, switch off the director's loan that we're going to need right at the beginning. And then we can automatically see the shortfall there. So as you can see, it's an incredibly powerful platform. But I think one of my favorite features, which I will show in more detail later on, is actually this timeline feature. So if you look at sales and then you wanted to move that, rather than switching them off totally, we could move the commercial to say it's not happening till March 28. And then everything under that commercial category gets moved across. And then you can go back to your dashboard and see the impact of it there. So super powerful. And as I say, I'm going to talk you through line by line how to create this. So let's go. Okay, so let's dive straight in and create our new plan. So as you'll see when you go into here, that you could create a blank plan completely from scratch. The great thing is though that a lot of thought is being put into thinking about the different revenue streams and costs associated with a whole number of different business types. So as you can see there, sort of most business types have been thought of. And it just makes it so much easier if you're starting from scratch and you don't necessarily know what revenue and costs you're going to have. So to give you an example of this, I'm going to click on the construction, and this is going to be our example today. So let's call it something super original like ABC Limited, and we will start the plan from the start of the year. Now, as you can see, you could go up to 10 years, down to 1 year. We're going to go for 3 years to keep that reasonably straightforward. Currency, whole range of currencies to choose from, but as we're in the UK, we're going to go for pounds. Similarly, tax system, we are going to go for VAT. So let's start our plan. Okay, so as you can see, we've got all of this pre-populated. If you went for the blank template, you wouldn't have anything here. So you'd have to add a section first, then you'd have to add add a section, sales, add residential, commercial, etc. Add your next section, operating costs, blah, blah, blah. So this does really speed things up. Quite often there are bits, which I'll show you in a minute, that aren't relevant, but it's super easy to delete those. So for example, with our particular model that we are going to build today, we are only going to look at commercial and residential. So we're not going to do any maintenance. So let's just click on that whole section and click delete. Okay. And then in terms of commercial and residential, So I've actually got some figures that I've asked one of the LLMs, one of the AI bots agents to go out and create for me. So I will be copying and pasting the revenue amounts and other things from that financial model, but using it in here to create something that is a lot more robust. So we are not going to do within the residential, we're not actually going to do new builds. So let's just delete that bit as well. And then I'll just quickly tidy all of this up to how we want it to look. So, okay, so we've got our 3 income streams, and then we're going to add costs associated with them in a bit. But before that, we need to actually fill in what these amounts, what we're forecasting. So let's take a look at the residential refurbishment line. So one thing I would say, if you've got assumptions against your income, which notoriously is very, very difficult to predict, but it would be good to click on the comments panel there, and then you can record whatever assumptions you've made for that particular revenue stream. For simplicity today, I'm not going to do that, but I would thoroughly recommend doing it for your own model. And in terms of entering the income, you could do it as a per unit amount, or you can do it as a income per month or per quarter or per year. If you're a retailer, then obviously it would make sense to do it as a per unit price, or manufacturer or whatever. But for our example for construction, we're going to do it on well, actually, we're not going to, if you do it on a monthly basis, that will just give you a figure for that month indefinitely. So let's put in 80,000, and then we'll save and close, and you can see what that looks like in terms of, it's just going to be going up by 80,000. So if we look at the profit and loss, well, that's the budget. Let's go to the profit and loss. You can see that it's 80,000 each month, which isn't necessarily what's realistic. So let's go back and have a look at changing that. So the best thing to do is click across the table toggle there, and as you can see, that's what we've entered so far. If you then click on the orange fill button, so you click on there, that then allows you to adjust these figures on a cumulative basis. Okay, so let's say if we wanted to increase revenue by 2% each month starting at the beginning of the plan, then we could do that, and it will increase each month indefinitely to the end of the plan. Which, if you just wanted to have a very simplistic view, it's not a seasonal business, then that could work for you. But obviously construction is seasonal. You tend to find that in the winter months you sell less. So we want to actually copy and paste into these cells using a model that I've created in, as I say, within the LLM. So let me just click and copy and paste into there for each of these. Okay, so we can see now that each of those is pulling up into the revenue for each of the respective months, and we can see that it's coming through with the cash flow as well. But obviously this isn't realistic because we don't tend to get paid by our customers each time we invoice them in the same month. So we can go back and adjust that. Okay, so if we go back in to each of the income lines and look at the payment terms, we can change that to 1 month, 2 month, 3 month, 4 month delay. Typically it's probably more like 45 days to 60 days, but let's be optimistic and go for 1 month delay on all of them. And so now if we look at our reports and your cash flow, you can see that we've got no cash coming in that first month because we've got a delay of 30 days. Something super useful actually to show you here whilst we're just looking at the revenue, but this applies to costs, to investment, to anything that you want. And again, this is why I think this model is far superior to anything that AI can currently produce. Is if you go to the timeline, you can then, for any of the modules, move this across. So let's say, for example, commercial new build is a new activity that rather than it starting at the beginning of the year, so we can actually move that to say that it starts July 28, and then that revenue would only then be coming in at that point in time. So if we go back to our reports, and did you see that then changed to, so February 26 is now 201 600, whereas before it was 270. So that's a really, really valuable tool, especially when we come on to looking at hiring staff, because that's one of the things that's really difficult to predict. And invariably, it has to match when, when the income comes in at the right sort of times, etc. Okay, so we're now going to start looking at adding the costs associated with these revenue streams. So the direct costs, cost of sales. So click on add components, and then we will go to, so we want to look at the expenditure line here, and we want to click on the cost of sales there. So this is associated with the residential refurbishment. So if we click on there, okay, and we're going to call it materials. So rather than having the table as we did before, we're just going to do it as a percentage of that income, so of the residential refurbishment income. So let's say that is 30%. And we will then do payment terms, 1 month delay again as well. So following exactly the same procedure, I've done this for CIS contractors, where I've gone 28% of income, plant hire, where I've done 4%, prelims 10%, and then direct staff 10%. Now, there is an employee module that we could use for direct staff, so you could do them individually, but just for ease of showing this demonstration, I'm just going to do 10%, and then I'll show you how to set up the overhead employees in a bit. So just click that back on, so that's in there. And so we're going to do exactly the same for down here, and add the cost of sales associated with each one of those. So we can do it individually, as we have done here. You would just then highlight that and move it up, and then call it materials, etc., etc., and do the same there. Or I'm going to do it based on the whole of the commercial amount, and I'll fill that out for us now. Perfect. So if we now look at the reports, hopefully we have got a sensible gross margin in there. So yeah, 18% looks sensible across the board. And obviously we've got to put in all these costs here to then get a sensible operating profit. Okay, so we've now got all of the direct costs associated with our income streams in here. What we now need to do is go through and put in the operating costs and the employees and marketing costs. Taking operating costs first, these tend to be fixed costs relating to, let's say, your office, so your rent and your utilities. They might be licenses or insurance. So you've got various costs here relating to public indemnity insurance, professional indemnity insurance, health and safety, accreditation, etc. It could be legal and accounting, estimating software, tender platforms. So things that tend to quite often they're annual costs, but they could be monthly, but they're generally fixed overhead. So we'll go through and enter all of those now. Okay, so that's all our operating costs in. As you can see on the platform, marketing is put as a separate line. I'm just going to put it within operating costs and just delete that section. Just put it as a one-liner within operating costs, just to keep things straightforward. Just add, and we'll call that marketing. Okay, so we've got marketing, and then we're just going to have a one-liner there, which is going to be marketing and business development. Obviously, if you've got divisions, then you can structure it that way. That's the beauty of all of this, is that you can set it up as you currently have your business reporting structured. Obviously, if you're starting a new business, then using these templates is actually a really good guide, because it can just help you think about things that you might not have thought about before. So let's put that in there. We'll save that. So we've got marketing and BD all within there. Okay, so if we take a look at our reports again now, you can see that we've got those operating expenses coming through. If we just switch off sales for a second, then you can just see them in isolation. And you'll also be able to see from the cash flow that we need to change the timing of when we're going to make those payments, because in a similar way to the income, we don't pay our suppliers the second we get an invoice. So I'll go through and change all of that as well. And actually, something really useful to note here before I even go and change those is that even though we're profitable, so you can have a look at the report, so you can have a look at the profit and loss account, and even though from day one we're forecasting that we're going to be profitable, highly unlikely if it's a startup, but hey, we're forecasting profitability there. But actually, going back to the dashboard, you can see that we have a cash flow deficit up until at least May. And this is before we've even taken into account the fact, if we delay paying our suppliers, then that will make it slightly better. But even so, this is a really good example of, actually that sort of working capital requirement that you have as you grow a business. Okay, so for head office, normally you actually pay in advance for that month, so I'm not going to change that one, but let's go through and change the others. So we'll do 1 month's delay on all of them. One thing is actually worth looking at, and I should have thought about this before starting the model, is, it's because I wasn't starting from scratch, to be fair, but if you go to settings, and you go to financial settings, you can change it so that there's for any new cost of sales or operational cost components, you can have a global delay set. But because I already had some set up, because I was using the template that had been created already, that wouldn't have worked. But if you're starting a plan from scratch, go into settings first and click this, and then you won't have to just do what I just did then. So back to the dashboard. I just realised I've missed out one additional cost, so let me just quickly put that in. There we go. Just double check that. That's all good. Do my payment terms now. Done. Okay, so the next thing to look at is our employees. So as you can see, we've got all of these set up already for our construction business. Okay, so let's take a look at these. So the skilled labour, they're effectively direct costs, which if you remember before, we had put in as cost of sales as a percentage. I think we chose 10%. So we're just going to delete that section there. And then we're just going to have like technical people and then admin people. And for each one, we basically can go in. I'll probably change some of these names. You can put the number of employees at that salary level, and then, very similar as before, you can put the table, etc. You can add their pension contributions. You can add the national insurance rates. In settings, it's already set up with the UK national insurance, so we're just going to go save on that. And then payment terms will be, so national insurance will be 1 month delay, and we're going to have no delay for our staff salaries. So I'll go in and complete all of this. Okay, so we've got all our employees in there. As you can see, things are looking a bit dire, so we'll have to do a sense check in a bit. But let's come on to assets. So within the asset section, again, we've got pre-populated assets in there. If you want to add some more, then just go to the components. We need to go down to this asset section here, and then you just add new ones in there. Conscious of time, so I'm just going to zoom through this whole section on there and then delete some of these other bits. Okay, so as if by magic, all of our assets have now been put into the plan. So I've split them out by machinery, motor vehicles, IT, and then for our new satellite office, which hopefully will be opening a year from now, then I've just bundled everything together there. Obviously, you can be a lot more granular with this. I've collectively put transit vans together, laptops together, desktops, etc. But you can obviously do all of these individually, or you could just have one line depending on how much detail you need to go into. One thing I realized I didn't explain was what these assets are. So typically you would put an item onto your balance sheet if it has a useful economic life of more than a year to your business. You could put a de minimis on that. So certain items that are less than £500 or £250, you might put to the profit and loss account, even if their life is longer than that. But typically anything of sort of significant value with a life of longer than a year, you would put into your balance sheet, and that's where we would put them here. And then you would select a depreciation rate depending on how long you think they are going to be used within the business. So just diving into a very specific example of that, so you can see how it comes through onto the balance sheet and profit and loss, etc. So we've got a Ford Cougar that we're anticipating is going to cost us 28,000. We're depreciating it over 4 years, and we haven't said that there'll be any disposal value at the end. If we selected that and put a date when we expect to sell it, then we would then see a profit or loss come through at that point of sale. I'm not going to complicate things with that right now. And instead, I just wanted to show you how this is then featured on your different reports. So as you can see, we spent 28,000. We should then see that going out in terms of our cash flow. Also, just to let you know, if you want any of your modules not represented in the reports, you can switch them on and switch them off by literally clicking on here. So as you can see, I've switched off all of the other things that we've set up so far. But if you wanted to, let's say, put the transit vans into that as well, you can see then the asset cost is going through on the cash flow there. So let's just focus on the Ford Cougar for now. So you can see that that is then being reflected in terms of cash flow going out. In terms of then the profit and loss account, we are then seeing, because we know it's gone to the balance sheet, this is the depreciation. So this is basically 4 years worth of depreciation divided by 12. So 1 month's worth each month over a 4-year period. And then that is then reflected in the balance sheet. So you'd have obviously the 28,000 less the 1 month of depreciation. This is the balance at the end of January, end of February, etc. So each month you are taking the figure and reducing it by the amount of depreciation that is then being released into the profit and loss account. So I just thought that was a really good example, so you can see how it all flows through to these different reports. So just going back to the other assets that we could have in our business that I realized I haven't mentioned yet. This investment section relates to, it's not investment into your business from, let's say, an angel or venture capital firm. it's the investment that your business is making with its spare cash. So in our particular example, startup, highly unlikely that we will have spare cash. But if you did, then that would be where the module that you would use. I'm not going to cover it in this particular example for obvious reasons. And then also stock. If you're a retailer or a manufacturer, then stock is going to be very significant in your business. And again, it's outside of the scope of this particular example, but you can link your stock with your cost of sales as well. So very happy to do another example going through all of this if there's sufficient demand for it. So yeah, contact me if you'd like me to create something on that. And then in terms of the final little bits that we need to look at, it's funding and equity. Now, as mentioned before, this was set up as a template company for a construction business. And interestingly, I noticed I was a bit confused when I looked at this a little while ago, thinking, why would you have capital injection within grants? And actually, when you look at the little symbol here, it is actually a capital injection in terms of for shares. But I would actually not have that within the grant section. I think it's a bit confusing in there. And so I've set up a new equity section, and I will move that across into there. So in terms of just moving that, I've just clicked on the capital injection, and then you can move components. So you can move it into the equity bit there, and then you can just move that straight across. And that obviously applies for anything else that you've put in the wrong place. So that's kind of quite a useful little trick. And then if we go to the equity section, we can now obviously see that it's in there, and I've added some initial share capital. So now would be a really good time to work out what our shortfall looks like in terms of the initial investment into the business. So let's just put everything back on. Okay, so everything's been switched back on. Also, just to let you know, within the assets, because I'd individually switched all of those off, I had to go in and manually switch those back on as well. So don't forget that if even though it looked like it was switched on here, it needed to be turned on. All of these needed to be clicked back on individually. So what we now have is our dashboard for, well, each of the years. So we're showing it monthly at the moment, and you can see the great thing about this platform is that you can see straight away what your funding requirements are. So you can see pretty much it's in that first year that you're going to need it. In fact, in that first month, because of all the assets that you're acquiring in that first, setting up the office, etc. So using that, if we, let's say, put in 400,000 either as equity or as a loan, then we should then be covering our funding requirement, and hopefully our graph is going to look a lot happier by the time we've done that. So let's pop back into funding first. Okay, so I'm just going to get rid of these ones here, and we're just going to get rid of our grants as well. And I think we're going to add a new type of loan, being, I think we're going to call it director's loan here, because let's say that he's had a massive payout from his previous construction business and wants to invest into the company. Now, it could be that the director decides that it's let's do it for 200,000. Okay, and we want it at the start, so we still know we're going to have a shortfall, but let's just say that the director is going to do it for how many years, let's say 5 years. Okay, starting then. And then you can choose if you want to do interest only, manual repayments, fixed payments, or decreasing payments. So let's have a look at fixed payments, and we can set the interest rate. So it might be that it's interest free, but let's just put let's say 5% interest calculated monthly. Okay, obviously you've got the table toggle there if you wanted to do something a bit more complicated, but let's just do that. Okay, so now that will be impacted in our forecast. If we switch everything else off again and we just look at the dashboard there, so we can see that initial 200k coming in at the beginning of January, and then amounts going out in terms of interest and repayment. So let's just have a look at the cash flow statement. You can see that we're paying the interest there, but then we've also got a capital repayment as part of the amounts that we're paying out each month. Now you can obviously have a play around in terms of the value of the initial loan, the years, the rates, etc., and just sort of see the impact that that has there. So then in terms of the final section being equity, so let's just turn that one back on. So we've put in the initial, share capital here, and then capital injection. Let's say that we are then going to have the remaining 200k. Okay, so let's say he invests 1,000 as 1,000 shares for £200 a share. And then hopefully when we click everything back on, we will have sufficient capital at the start. But before I do that, I just want to quickly say that this is the area where you would then also put in anticipated dividends. So I'm not going to do that in this particular example, but you can do it as a percentage of profit or dividend per share, and then that will also flow through in your cash flow and in your profit and loss account and balance sheet as well. So yeah, just wanted to highlight that whilst we were in there. So just clicked everything back on, and if we go to our dashboard, yay, we've now got sufficient funding so that we don't have any additional funding requirements in here, which is super exciting and a bit of a relief, to be honest. And as you can see, over time, our cash balance is sort of gradually getting more healthy, which is obviously how we'd want it to be. So I hope that's been valuable. As I mentioned at the start of the podcast, I would do the big reveal as to the name of the platform. And if you've made it this far, then I guess you're pretty interested. So, drum roll please. The name is Brix, BRIXX. And I just want to say I'm not in any way affiliated or invested in that business. I just think it's a phenomenal platform. And I hope after that demonstration, you would agree with me. So as I mentioned earlier, if there's anything you want me to dig deeper into, then I'm happy to record some more of these. They do take quite a long time, so bear with me. But yeah, just get in contact if you think that I can be of use in terms of utilising the platform. But the team at Brix are also incredibly good at answering questions, etc. So hope that's been useful. Always looking for feedback, so just let me know if there's anything else I can do. Thank you.